Despite policy and geopolitical shocks throughout the year, the global economy has shown resilience, policy volatility has eased, and AI-driven capital expenditures have accelerated, supporting a more constructive outlook. However, growing fiscal concerns are beginning to weigh on longer-term growth prospects. The Fed's decision to resume rate cuts is a preemptive move, aimed at stabilizing a softening labor market rather than responding to a broader downturn. September's cut likely marks the beginning of a measured easing cycle. We expect a total of 3 25 BIS cuts this year and further reductions in 2026. Yet, the broader economic backdrop remains resilient, supported by strong consumer spending, robust AI-related investment, and fiscal stimulus. The Fed is navigating a complex environment, including tariff-driven inflation risks, shifting labor supply dynamics, and concerns about data reliability all point to a cautious and gradual path forward. US recession fears have been dismissed, with broad macro data have been resilient, supported by robust household and corporate balance sheets. AI-related investment emerging as a significant growth engine. Technology investment alone is estimated to have contributed roughly 1/3 of real US GDP growth in the first half of the year. While tech remained central to the rally, more cyclical areas of the market, particularly small caps, also began to recover after a prolonged period of underperformance. Global equities joined in the strength, with Asia and emerging markets delivering exceptionally robust returns. European markets have benefited from Germany's fiscal stimulus and ECB rate cuts. However, high political uncertainty and fiscal stimulus implementation challenges pose risk. In Japan, rising inflation and economic stability support another rate hike, though political changes may delay action. China's economic outlook remains mixed, weighed down by property market weakness, but China equities are buoyed by optimism in tech and abundant liquidity. Elsewhere in Asia, both Taiwan and Korea should continue to benefit from the structural AI tailwind. India is caught in the cross-currents of US immigration and trade policies, with Indian assets underperforming substantially. This presents an opportunity for long-term investors to add exposure, as the domestic structural growth story remains intact, pushing the Indian government toward further reforms. In the US, large-cap tech continues to lead, but stretched valuations make future gains increasingly dependent on sustained earnings growth. Small caps gained traction in Q3, supported by rate cut expectations and solid macro data, though further gains hinge on additional easing. Europe started the year with attractive valuations, but Germany's fiscal overhaul triggered a repricing, and stalled earnings now require new catalysts. Emerging markets valuations remain more compelling than developed markets, with China benefiting from tech optimism and policy support. It may also gain from upcoming Fed easing, though domestic policy remains critical. Solid corporate balance sheets and fundamentals create a favorable outlook for investment-grade credit, but historically tight spreads make issuer selection critical. Growing concerns around fiscal and debt sustainability has pushed the term premium higher, steeping long-end government bond curves in advanced economies, while credit curves remain flat. Investors should consider shortening credit duration, focusing on income opportunities at short to medium maturities, and extending duration in Treasury, which should remain supported amid softening US labor market. Local currency emerging market debt may benefit from rate cuts, but given strong year-to-date performance, selectivity is essential.